I guess that means I'm supposed to start. The music stopped. So thank you everyone for coming. I'm going to be really annoying and kind of like walk around a little bit, and I hope I won't drive the AV people too much crazy. But I'm for those. I guess I did this at Sophie a few weeks ago. How many people in this room actually don't know who I am? Okay, this is a decent crowd, so that's good. So my name is Ed Toy. I work with Risk and Regulatory Consulting, which is a consulting firm that works almost exclusively with state insurance regulators, doing pretty much anything that Director Dunning wants me to do. So that's a good thing. Before I joined, actually yesterday was my 6th anniversary with RRC. Prior to RRC, I spent 10 years with the NEIC. As director of the Capital Markets Bureau, and before that, except for a brief period when I ran away from home and went to a hedge fund, I've spent over 20 years as a portfolio manager with a major life insurance company in New York. So with all of that background, and also for those of you who don't know me, I've been dealing with insurance regulation on this point a little bit more than 30 years. So I'm very, very happy to be part of this effort. I'm going to be spending today, the next, at this point, 49 minutes talking about what's going on in the commercial real estate market. It is obviously a very big topic in the last few years for one reason specifically, but for a variety of different reasons. So we're going to try to kind of jump into this right away. This is just a general description. We got the learning objectives. You can all read all those things for yourselves. So before I get started, if all of you will promise not to leave the room, I will give you at least one answer. Supposed to be concerned about? Are we supposed to be freaking out and running all over the place and saying, oh my God, what's going on with commercial real estate? And the answer, of course, is absolutely not. What has happened, though, is, again, this is jumping way ahead, but to tell you, what is happening is we are looking at a situation where an asset class which historically has always been a little idiosyncratic, that you can have one office building on a corner doing very well, and the other office building just across the street that just does absolutely horribly. That has always been kind of like the nature of this asset class, but one of the things that we're seeing in the last 3 or 4 years is that degree of idiosyncrasy has dramatically expanded, and it is much, much more serious than it ever used to be. It used to be kind of like, well, high tide lifts all boats. Kind of like that, even though I get seasick on the Staten Island ferry. But high tide lifts all boats, and so even like crappy stuff kind of does okay when the market does okay. What we're seeing now is that that's not the right paradigm anymore, and then in fact you see situations where the divergence is huge. And it's kind of like now it's turned to almost a storm surge or a tsunami where a lot of stuff will do fine. It will, if it suffers at all, it will recover. But there's other stuff that otherwise might have gotten picked up with the high tides, and it's not doing it. Now it's just getting crashed against the shore and being destroyed. So that's kind of like a headline I want you to think about as you would look at some of the other headlines. And obviously, I'm not going to go through all of these different things, but I wanted to give you a little bit of a flavor, in these first 2 slides of the kinds of things that we're seeing, and obviously remembering that these are headlines. The point of, whether it's the Wall Street Journal, the New York Times, or whoever else putting this out there is they're selling newspapers, and so when they see something that's worth talking about, they're going to put it out there. This is not meant to say, oh, this is what's happening everywhere. But just in the last, when I was putting these slides together, in the last 6 months, This is not before 2024. It's the first 6 months of 2024. The number of headlines I saw in just the Wall Street Journal and the New York Times, basically. I think there's one headline from Bloomberg, where you see like what people are saying, the headlines, what's going on, dramatic, concerns about losses, whether you're talking about certain areas or just an example. I was just talking just a few minutes ago. There was one example. I think it's a building in New York. I can't even remember now. Where just a few years ago they bought the real estate owner bought a building and they recently sold it for 5% of what they paid for it originally. So you see that kind of a headline is what we're dealing with. So first, before I get into like all the market dynamic stuff, let me spend a few minutes talking about industry exposures. And I'm going to focus primarily on the life industry because just like everything else, that's where most of the insurance industry's assets are. But I've also got some information about the P&C side because the number, which maybe 15, 20 years ago was kind of like almost zero, P&C is not zero anymore. It's still not a significant number, but it's not zero anymore. So I've got some P&C numbers as well. But we're focusing again on the life side, and here, just to make sure you see the column headers, the number on the column on the far left is 2013, so that was 10 years ago, and then I've got the last 5 years worth of data. So you see the total exposure reported primarily on Schedule B, because that's where the commercial mortgage loans are, and the mezzanine loans, as well as residential and the other means, agricultural loans and other miscellaneous kinds of things, as well as some other data points. So you see the fact that the commercial mortgage loan portfolio of the life industry in the last 10 years have gone from roughly $322 billion to now almost doubling to $611 billion. That's a pretty substantial increase in dollar amount. You also see, some growth in terms of mezzanine loans, although that's always been a pretty kind of like minimal number. Residential mortgage loans, another, that on a percentage basis, that's a pretty substantial increase. Some of that, there are some dynamics of that, mostly having to do with what's going on in the banking industry, but that is becoming a more material number. And then you see the information that I've got here, especially the highlighted one in yellow about problem mortgages. Those are things, anything that is not in good standing. And then I've got a few data points down at the bottom there, and you see, obviously, at this point, the problem mortgage percentage, two things, the problem mortgage percentage, while it obviously we've seen a pretty significant percentage, pretty significant increase, it's still less than 1% of the mortgage portfolio. So, yeah, there is obviously reason for concern, or to at least look at it more carefully because it's gone up so much, but it's still less than 1%. And of course, that's the problem mortgages. Hopefully you get at least some recovery in that. That's not a total loss. And then the other thing I wanted to highlight is commercial mortgage loans as the largest part of the asset class as a percentage of total unaffiliated assets. So notwithstanding the fact that the dollar amount has virtually doubled from 322 to 612, as a percentage of assets, it's gone from roughly 10.5% to 13.5%. So that's obviously it's increased, but it's not like, we just like suddenly as a percentage of assets, the growth has doubled. No, that has not been the case. So that's some basic data. We look at the P&C side, and I won't go through all these numbers the same way I did before the life side, but I wanted to put that out again, focusing on not so much that, these are big, huge numbers, because they still aren't. But relative to what they were a few years ago, 10, 15, 20 years ago, when you kind of like could almost ignore mortgage loans as an exposure in the P&C industry, you can't ignore it anymore. It's not so much material, it's not so much significant, but it's not a zero number. The other thing, obviously, whenever we talk about industry-wide data is also, this is industry-wide data. This is not, you're going to have individual companies that have data points that are significantly different than this. You're going to have individual life companies that have much, much higher exposures, that have much worse experience as far as their delinquencies, and the same is case, maybe less so again, but the same is probably the case on the P&C side. So this is industry-wide data. It's and individual companies you have to look at. And part of what I do whenever I work on exams is I always look at this kind of information and I look at the individual companies. Okay, how does the individual company compare with some kind of a peer group? A few other slides, just again, I won't spend too much time on these slides. This is just to give you some context of what's been going on in terms of growth in the industry, in the asset class for the industry. You got percentage of assets. I did want to have one slide here, even though it's not the primary focus of my discussion points today, but what is the CMBS exposure, and focusing specifically on the non-agency commercial mortgage-backed securities exposure. That number has also, you see kind of like the same dynamic across all of the insurer types, that there's been some decent growth in the last 10 years, but it's not, that growth is mostly on the dollar size. It's not so much on the percentage side. So there is some growth. The only thing, and this data is not here, is when we look at even the non-agency CMBS exposure, to the extent that most of that exposure, and it varies from year to year, how much of that exposure is in the AAA and the AA rated classes, which is really, there's no real risk that that's going to go into default. That ranges anywhere between 50 and 75% of any kind of like non-agency CMBS exposure. So, and then you've got the single A's and you've got the triple B's, and the percentage that's held that's below investment grade has always been a pretty small number. But just to put that out, when we talk about exposure to commercial real estate, it's not just what's on Schedule B and, to the extent that it's real estate equity, what's on Schedule A, but it's also things that are reported on Schedule D, primarily of which is going to be the non-agency CMBS numbers. So coming back, the commercial mortgage loan exposure, which is the primary place where the insurance industry, the life industry has its exposure to commercial real estate, let's start with some of the basic characteristics. Going back, and again, I spent a good part of my career at a large life insurance company in New York, and they had a huge mortgage loan exposure, but they were very traditional in the way, at least at that time, they underwrote their investments. We're talking about relatively low loan to values. They, generally speaking, with very, very rare exceptions, did not go over a 65% loan to value. Those are going to be really unusual situations. They focused on high debt service coverage. So, anything at least 1.5, if not 2 or 2.5 times debt service coverage. It was always occupied, what they called stabilized properties. The buildings were always like at least 80%, if not 90 and 95% occupied with long-term leases. They always looked at the lease rolls as they got comfortable with it. They were generally speaking what they call Class A or Class A plus properties, although I think I make a comment later in the presentation, like that's not a legal definition. I mean, what is a Class A property? That's very, very subjective. Although there are clearly some things that people look for in terms of making that determination. I'm going to skip the next bullet and come back to it. The other thing that is true that you need to focus on in terms of looking at the mortgage loans is the amortization type. In the old days, they were all like 30-year, fully amortizing mortgage loans. So by the time you got closer and closer to the maturity date, it was almost all paid off. And so therefore, the refinancing risk was minimal. But one of the things that has really, really changed over time is that the market, not just the insurance industry and the way it underwrites, but the market has moved to shorter mortgage loans, shorter maturities of 5 years, 10 years, maybe 15 years, and they're almost all non-amortizing or minimally amortizing. A lot, I've got some data later on, just a couple examples, but the percentage that is interest only until the maturity date, or interest only for most of the transaction, or just minimally amortizing, those percentages are much, much higher. And also, again, they're shorter dated. Coming back to the bullet I skipped over, the other thing I've noticed, and again, this is in terms of working on all the exams that I've been doing in the last 6 years, is a growing number of insurance companies that are getting into construction loans. So contrary to the whole concept of I lend on a stabilized property, it's got fully rent rolls, now you're starting to see more and more companies getting involved in construction loans or some other kind of transition loan where it's not a stabilized property. Potentially there are no rent rolls yet, and there's construction risk. There's the possibility that you could have a problem. I was looking at on one company a couple of years ago where they happened to actually have a building about a 10-minute walk from where I live in Brooklyn. And I said, one afternoon, my wife said, well, let's go for a walk. It's really nice out. So I went for a walk. We walked over, and on the door is slapped a stop work order from the Department of Buildings. And that's the risk that you deal with construction loans, that things happen and suddenly the buildings department tells you to stop, or you can't get the materials, and then what happens to your plan as far as that construction loan? This is all very anecdotal because we don't actually have the disclosure in the investment schedules for how much of your portfolio, your mortgage loan portfolio, is construction loans. But anecdotally, I'm seeing more and more of that. And it requires a whole different dynamic in terms of monitoring that and examining that. The one last thing on this slide is that for life companies, this is not true for P&C and health, but for life companies, Life RBC did come up with a brand new way that is a little bit more risk-focused in terms of determining the risk-based capital for mortgage loans that are reported on Schedule B. It doesn't go the full length, but it's a lot better than what we used to call the MIF, the Mortgage Experience Adjustment Factor, which is just like a really, really strange thing. But that's why it was called the MIF. We like to joke about it. So they came up with something. It was adopted in 2013. It basically works. If I had unlimited resources, I'd do something way more sophisticated. But it basically works. It's a two-factor model that looks at loan-to-value and debt service coverage, and the debt service coverage is over a rolling 3-year basis. So it's a dramatic improvement over the MIF, but we'll see how it continues to work. So this is some data. This is just 2 random examples I took out of the exams that I've worked on. But property type is a major issue because different property types, they go through the swings, and I'm going to be spending a lot of time focusing on the office side of the commercial real estate market. But you look at the basic percentages, the one on the left is like almost 30% is in office properties. So if you have concerns about the office sector, that's a pretty high number. It's not as high as some companies, but it's pretty high. And similarly on the right side, you've got 27.6%. Multifamily tends to be, it's not perfect, but most people consider that one of the more stable of property types. Those tend to be, people stay, they don't, the rent rolls don't roll over that much. Occupancy rates tend to be really, really good. We obviously went through a period, an extended period, where there was a lot of concern about what was going on with retail, with online buying and things like that. But that seems to have finally stabilized, and I've got some slides with that. Again, going back to the amortization type, and you see some of the basic data points here. On the left side, fully IO, meaning nothing is amortized at all until the maturity date, almost 42% of their portfolio. And that's where you get the refinancing risk, because nothing is amortized. So therefore, if there's any kind of a glitch, whether it's in the market or the building, are they going to be able to refinance? Are they going to be able to go out and pay off that mortgage? And then that's obviously the riskier side of it. But then you've got even the partial IO and then amortizing, and within the amortizing minimally with a big balloon at the tail end. So in terms of anything that's fully amortizing, as far as the table on the left, it's only 12% of the portfolio that you can arguably say there's not a lot of refinancing risk with that. So those are some data points for you to just keep in mind as now I show you all the fun stuff. And all the fun stuff is talking about the market dynamics of what has happened, literally in the last 3 or 4 years. But going back a little bit further, this is some graphs that I try and keep, and it's an aggregation of all sorts of different data points. There's an outfit called Green Street that does a lot of good work in terms of following values. S&P owns something called CPPI that does that, and a couple other things. Maycreef does some work. So I kind of like pull it all together from different places. So, but trying to give at least some credit to, because I obviously didn't pull this data together myself. But here's what you're seeing. You've got national. And keep in mind, these are national index numbers. They include everything from New York to Wyoming to Texas to Louisiana. They include everything. So it's national data points, but the solid blue line is an all property index. So that's all properties. Now the one thing is the data sources that I pulled from are generally speaking, they're what they call the institutional data points. They don't include a lot of the banking stuff that's out there. They don't include a lot of the CMBS stuff that's out there. This is focused primarily on institutional kinds of properties. And the solid blue line, again, I think the focus I want you to pay attention to as I'm walking through these lines is the solid blue line. Look at what's happening with the solid blue line relative to the dotted lines. Now you go back to the beginning of this data set in 2006 all the way to 2012-ish, all those lines pretty much went the same. There was very little divergence in those data points. What has happened since then is the divergence. So you see the solid blue line, which is all properties, but then the dotted green line is the apartment or multifamily line, and that is done much, much better. Now, granted, it probably got a little inflated, back in that 2020, 2021 period, and there's been some pullback, but generally speaking, it's done really, really well relative, and it's pulled a lot of the national index numbers up. On the other hand, you see the dotted red line, the retail line, and that is, again, as I said before, was struggling for a lot of years. A lot of malls that were built in the 70s and the 80s ended up becoming empty space and had to be shut down. There was a lot of reconfiguring of even other kinds of retail space, but that seems to, so that struggled for a lot of years, and since then seems to have stabilized. It seems to have found its footing. They've gotten rid of enough of the empty space so that certainly the experts say that they're a lot less concerned. But then you see that the dashed purple line, and that is the office space. And what has happened, and again, I'm sure all of you already know this, is what has happened since COVID is that in 2020 is how many companies are deciding they don't need that office space anymore. They don't need 5 floors. I mentioned this at a different presentation a little while ago. Even the NEIC here in Kansas City has given up 2 out of the 5 floors that they had in the Town Pavilion building. They just gave it back. They don't need that space anymore because people are not coming into the office 5 days a week. I have the same experience. I have access to office space for RSM, an accounting firm that my firm is affiliated with, and I used to go in there every day. Before COVID. I don't do that anymore, but I've gone in a few times just to make sure my pass is still working, and I walk in and the floor has got 20 people in it. So I think, how much longer is RSM going to keep 3 floors in prime real estate in Times Square, in the Times Square area of New York? I don't think so. So that's, and while it doesn't actually display here, what you see in terms of that dashed purple line is that compared to the peak, which was just before COVID, the national index numbers for office values is down more than 30%. That's a national index number, and as at national indexed average numbers tell you, some buildings are obviously doing much, much better than that, but then there are also other buildings that are doing much, much worse than that. It's like not everybody is above average. So that's just a graphical kind of thing. So some key data points and some of the stuff I mentioned while we were looking at the graph, you look at the last 12 months, National Property Index in the last 12 months, this is through July because I didn't have the August numbers yet. National Index's numbers is down 5%. Retail is actually up 1%. Apartment is down 2%, but that was like, again, it got really, really high up there. Office in the last 12 months, down 9%. Since pre-COVID, January 2020, National Property Index is down 9%. Retail down 12%, apartment down 7%, office down 39% since 2 months before COVID became a pandemic. And that is compared with the S&P 500, which in the last 12 months is actually up 19%, and since January 2020 is up 67%. So obviously that's an apples and oranges comparison, and yet at the same time to throw that out there is like, this is what you're seeing in terms of commercial real estate values. Now, there are a lot of market-based issues. I already talked about retail. That seems to have stabilized after a lot of years of struggling. Nobody, including me, ever thought that bricks and mortar retail was going to go away, but it needed to restructure. It needed to reformat. It needed to get rid of some of the excess space. The office sector is clearly the biggest concern today, and it is the central business districts. It is Midtown New York, where the vacancy rate, meaning unleased space, is up around the mid-teens, 14, 15%, but that actually understates it because they have now the key cards and they know how many people are actually coming into the building. The occupancy rate in Midtown New York is 50%. So you think about, okay, you have all these office tenants that people are not coming in and they hold 2, 3, 4, 5 floors. What are they going to do? When that lease expires, what are they going to do with that space? It's quite likely they're not going to keep it, which means there's a lot of excess supply, at least for now. At least for now, there's either is or is going to be a lot of excess supply. Question was asked before, can any of that space be reconfigured to be something else? Obviously, there was some success in retail with reconfiguring some of the mall space. That's a good thing. It's going to be really, really hard. There are clearly examples where it's been done in cities like New York, but it's going to be really hard to reconfigure office space to be something else, and primarily would be residential, because office building footprints are not configured for the rules for residential multifamily apartment space. You have to have a certain number of windows. You have to have a certain amount of fire exits, egress, all those different things, and not all of that works. And again, the example I was giving before was there was an office building, I'm pretty sure it's in New York, where to satisfy the needs to reconfigure, they actually basically dug a hole in the middle of the building. They created sort of like this space where they could put in more windows and add some stairwells, and so they were able to do that. But they were able to do that economically because they got the building for virtually nothing, so they could sink the money into that reconfiguration. Apartments, multifamily, and industrial through the last few years, those have clearly done the best, but this is a cyclical industry, so will that continue? It's hard to tell. Certainly, the whole idea of the warehouses and the data centers, that's done great in part because there's been this growth in online shopping and not going out to the stores. But at some point, that will start to level off, or certainly one would expect that to level off. I already talked about the office, the vacancy rates versus the occupancy rate. The one other bullet point is some people ask, well, COVID was 2020. At this point, that's almost 4 years ago. Isn't a lot of that already kind of like flowed through the system? And the answer, as a general answer, is no, because there's an awful lot of situations, and the data, I have a good friend that tracks this data incredibly carefully. And what he sees is that, for the last 2-3 years, a lot of office tenants have said, look, I really don't know what I want to do long term. I really don't know if I want to force people to come back to the office full time, or if I want to go to just 1 day a week, 2 days a week, 3 weeks a week, days a week. So let me just extend my lease. Let me just push it out 2 or 3 years. Let me just go to the landlord owner and say, look, if I have to decide now, I'm walking away. But if you give me 2 or 3 years at some favorable kind of like rental rate, I'll keep all the space for now. So there's been an awful lot of extension of that. And how much longer is that going to last? Or before it kind of like starts to okay, we're done. We've decided we're not either. We're either coming back or we're not. Also to a lesser degree is also occurring with some of the, primarily the bank loans. Banks are extending. They're saying, we don't want to foreclose. We don't want to take that step yet. So we're just going to extend the loan. We're going to restructure, or we're going to refinance by giving you a new loan that is, instead of a 65% LTV, is an 85% LTV, whatever. But at what point do the banking regulators say, no, you can't keep doing that? That's like going back to the days during the great financial crisis of zombie loans, where it's really a non-performing loan, and you're just hiding it in your balance sheet. So that's an issue. We'll see, how much of that starts to finally roll through. And then the last bullet point I think here is also significant. I talked a little bit, I showed you those graphs, and but the other thing I've noticed is I track this data month to month. And again, it's national data, it's coming from all sorts of sources. A lot of these are private transactions, and so you got to take it for what it is. But what is startling to me is the volatility from month to month. I mean, think up until 3 or 4 years ago, you saw the numbers from one month to the next move a little bit. It's like up 0.5%, down 0.5%, up 1%. In the last 3 or 4 years, you've seen data points where, the office sector, again, the index number is down 6% in 1 month, or it's down 9%. So now you're talking about, if you think about the national index numbers, you did a loan at a 65% LTV, and suddenly a month later, it's a 75% LTV. It's like, so that volatility is another change in the dynamics that makes it very, very difficult now to look at this asset class in the same way we did a few years ago. A few other things just to focus on in terms of where we go with some of this data and some of these concerns. Obviously, and this is again primarily the nature of life insurance industry and their investments in mortgage loans, is they have always focused on sponsor strength. They don't pick up everything just flowing through the market. They think in terms of, I work with Tishman for 50 years now, and they're a regular developer, and they always put in capital. And so a lot of this is, there is some comfort in the sponsor strength. As long as the sponsor is doing well, overall, there's something to be gained from that. Although I will say, and again, taking on my personal experience in Brooklyn, we had the monolith. My son used to call it the Tower of Sauron. It's the tallest brick building in Brooklyn these days. And, major regional developer anyway, sunk $150 million into it, got loans for $650 million. It's an $800 million. He needed another $50 million to finish off the lobby area, and he said, no, I'm walking away. There is your Class A, granite, everything, all beautiful. And he just said, I'm not sticking another $50 million day. Here are the keys. So even though sponsor strength should give us some comfort, it's not the be-all and end-all. A key thing, driving a lot of this is keeping up with with rival properties. Again, the notion that, okay, to keep their tenants, one building says, well, I'm going to build a gym, I'm going to put in a restaurant, I'm going to do all this wonderful stuff. And what do all the other buildings in the area have to do? They've got to do the same thing. They've got to keep up with the Joneses, so to speak. And then I already touched on the issue of mortgage loans. So other exogenous factors to really think about, it's now a little bit old news, but the regional bank failures, the issues that we had in the spring of 2023, those regional banks as a class, they provide between 50 and 60% of commercial real estate financing in the United States. So to the extent that regional banks are pulling back, either because they want to or because banking regulators tell them to, they're going to be lending a lot less. They're going to be lending more conservatively. So what does that do to market dynamics? Higher interest rates, obviously, we're waiting today. The Fed's going to come out at 1 o'clock as what they're going to do with the Fed funds rate, but we're also dealing with, at least for the time being, higher interest rates. So you got a mortgage loan that was affordable with a property owner, 5 years ago because they got a mortgage at 3%. Now at current Treasury yields, it's more like 5, 6, maybe 7%. Can they afford that? They might have been able to afford 3%. They might have been able to afford 3% reasonably comfortably, but can they afford 5, 6, 7%? We don't know. And then I already touched on the issue of non-amortizing loans. So what do we do? I got 15 minutes to tell you what do we do. So exposures are, first of all, we got to think about where are all the different exposures. I gave you some data points. They're primarily the things that are on Schedule A and Schedule B, but there's a lot of other exposures as well. I've noticed an awful lot of funds that are private funds, what I call private funds, that are reported on Schedule BA. A lot of those are real estate funds that were put in place 5 years ago when the market was great, and everybody wanted to find a way to invest in real estate. You've got Schedule D, things that are on Schedule D, obviously this is a different dynamic for those kinds of exposures, but you've got real estate investment trusts, and you've got commercial mortgage-backed securities, especially the subordinate classes, as I just mentioned. In terms of questions to focus on, obviously I've touched on a lot of these things already, but let me throw out the bullets. Maturing mortgage loans, what is happening with the loans? For the examiners and the analysts in this room, what is actually happening with insurance companies and the loans that mature in 2023? Did they actually extend those? Did they refinance those internally, or did they get refinanced otherwise? I think that's a good question to ask. They're not supposed to report those as brand new loans, because that's really it's the same loan. Need to understand the exposure. There's a lot for life companies. There's a lot of great data points in LR004. When we put that structure together, one of the things we did was we put in questions like, is the loan, what is the loan, what is the amortization type? Is there any kind of external credit support? Is there any provision that allows for negative amortization? Is there anything funky going on with the coupon? We have all sorts of great questions to help you look not just at the overall number, but to get some details on that information. You always ask the company, how do they manage their watch list? I mean, we tend to think, the watch list that's where you put your downgraded bonds. Well, watch list is also for stuff that's on the mortgage loan schedule. That is, okay, this is not doing so good. Maybe we got to think about it. What does the company have in place for loss mitigation? There are, if we use the residential mortgage loan market as a good example, there are lots of ways you can get away with and not have to realize losses if you get ahead of it early enough in the process. If you see, the debt service coverage number is coming way down, you've got issues with the building compared to the other buildings in the area, what can we do to start fixing and start dealing with it before that big balloon date? Companies need to have loss mitigation structures. I mentioned, always ask the question, are there construction loans in the portfolio? Because that is a completely different dynamic. I've gone, the full spectrum from one company that I was totally impressed with in terms of they meet on a monthly basis, they get data reports on a weekly basis, they go out and they visit the property at least once a year. They do all sorts of different things to stay on top of the construction risk. And that is, as opposed to another company I looked at that said, oh, well, we get the annual statements. It's like, is there something wrong with that? The other thing is, think in terms of the unfunded commitments. Construction loans mean if the sponsor, if the developer is meeting its targets, money has to go out the door on a regular basis. There are usually like monthly draws on that commitment. And unlike what we have in Schedule BA for the funds, we don't have reporting on unfunded commitments for construction loans. And then always in terms of CMBS, and again, that wasn't the primary focus of my comments, but in terms of non-agency CMBS, how much of the exposure is subordinate classes, which are subject to all of those potential problems, and also, is there any significant material exposure to what they call SASBs, or single asset, single borrower, which is, it's technically a CMBS, but it's one building. It's one big building in the area. So I've actually got 10 minutes to answer questions. So I'm sure Mustafa's got questions. Mustafa always has questions. Director Dunning?
I'm outside my comfort zone, so I don't have any questions for you, but I'm fascinated to hear what comes out of the room.
Yeah.
Do you think the lower interest rates, assuming they happen on a fairly quick basis over the next, several quarters, will that help the situation?
That's a really loaded question because embedded in that question is if it happens quickly. And, I'm not an economist, and to be very honest, I'm horrible at predicting interest rates. And yet at the same time, I will say I see no reason for interest rates to come down quickly. I think there's still a lot of concerns about, inflation popping back up, and, it's like there's just still things out there that's like, this is not the 2% core CPI number that the Fed is always looking for. So will they, is there a need to keep them this high? Probably not. Is there a reason to lower them? Probably. But to do it quickly, I think the Fed runs a real risk that inflation just like, oops, we're back up to 6% inflation rates. Maybe not 9%, but we're big. So given that, the obvious answer is yes, but it's yes on the sort of like industry-wide. Oh yeah, it's going to help the whole industry. Will it help the one individual company that has a non-amortizing loan that, based on the 39% drop in office property values, is now at 110% loan to value? And no, it's not going to help that. It's like, yeah.
Amazon's going back to requiring its workers in the office 5 days a week. Do you think that could start to be an inflection point?
I
more in-office work?
The question was, as an example, Amazon recently announced that they're going to go back to 5 days a week, get everybody to come back to the office. Will that be an inflection point? Will that be, that's going to lead everybody to? I don't know. Did that happen in Lincoln when you said everybody needs to come back 5 days a week?
No, but I wouldn't describe it us as intellectual leaders when it comes to like I've tried to intimate, I mean, I don't know, is this cyclical, is it a fundamental change? I will throw out as an example that when most of the investment banks in New York City that are primarily located in the financial district, they all basically went to, you got to come back 5 days a week. I mean, there were some exceptions depending on the department, but they all said, you got to come back. So in the financial district in downtown Manhattan, we're looking at 75, 80% occupancy. Has that changed the Midtown percentage of 50% occupancy? The answer is no. So it's going to be company specific, it's going to be industry specific. There are going to be certain industries that, yeah, I mean, we've learned that you don't have to be here 5 days a week. That was, to the extent that you want to look for silver linings out of COVID, that's a silver lining. It's great when we're here, but we don't need to be here 5 days a week. 1 day a week, 2 days a week. Maybe there's good reason for that. So I think it's going to be very, very industry and company specific. So, yeah, this table is like a good table.
We're fantastic.
Lots of questions.
Yeah.
Again, out of my comfort zone, but under the characteristics of exposures, you said you'd see growth in construction loans and bridge loans. Given all the variables that you mentioned that make that kind of an unsure landscape, do you have any idea what's behind that movement?
The question was, why, at least anecdotally, are we seeing more construction loans and bridge loans showing up in the insurance company portfolios? And the dynamic is, yeah, I mean, I have a pretty good, I am 90% sure that the dynamic that drives that is that banking regulators told banks, you got too many construction loans. Your exposure to construction loans is way too high. So stop lending until the number comes down. And what happened then? You had those brokers come through the insurance companies like, I can get you a 12% coupon on this construction loan. And, insurance company that was struggling because of low interest rates, like 12%, I'm getting, 4.5% on a single B-rated bond. It's like, sure, give me. You had more.
Is that still happening? Do you project that that's going to continue to happen, even with what we're seeing with still delays in supply and materials and all that?
One would think, not so much that where I see it continuing. I think there are reasons for thinking it's going to level off. But I think the main reason I see it leveling off, at least for a few years, is that are we already kind of like built out? Do we already have enough office space? Do we already, we've got some stuff coming online. There's always cycles in terms of building, and I think we're at one of those cycles where we kind of like got enough. So do we still keep doing it? I think that's the main reason I'm kind of expecting that curve to at least level off a little bit. There are other things included in the dynamics as well, I'm sure, but that's my main thinking. That I don't think we should expect to see it more, but again, that's the industry-wide. It's like, okay, what's going to happen to the whole market? Yeah, I expect it to level off. Where I always come back to, and I think Bruce always likes it when I say this, like, you got to look at the individual company. It's like, yeah, we should always get some comfort or some concern with industry-wide kind of like data, but you always got to look at the individual companies. And one of the things I always say, when I talk to people about sort of like the nature of our exam process is, it's not to say, oh, either do that or don't do that. That's up to management. But the key question is, what do they have in place in terms of controls and governance systems and all those different things to manage that risk? Recognize that construction loans are a completely different risk, and you can't use the risk and control systems that you have for lending 65% LTV on a stabilized Class A property to manage your construction loan portfolio. Do they have the systems in place to manage that risk? And of course, that comment is true for everything that you see on the balance sheet. It's like, we're long past the day when everybody invested in, investment-grade utility bonds. You can't use the management system for managing, investment-grade utility bonds, for also managing, Mustafa, the short-term trading.
You're saying that the investment shops are asking people to come back 5 days. That's not, and I see insurance companies and big insurance companies are not maybe 1-2 days a week.
Yeah.
And that trend is going to continue.
Yeah.
So with that happening, you're going to have overflow of commercial
Yeah.
phase.
Yeah.
Everybody's gonna try to get rid of
Right.
what they have. Losses, wouldn't that affect hedging and other areas?
The implications of, if we go with the assumption, and it is an assumption, we have to accept the fact that it's an assumption. If we go with the assumption that the world is not going to go back to everybody comes into the office 5 days a week, and I think personally it's a reasonable assumption for all the reasons that you say, that it's just like we learned, like it was great when we were all here, but we don't want Mustafa commuting an hour and a half every morning and then every evening to go home. It's great that he does not have to commute 3 days a week. He's a happier person. His kids might not be so thrilled, but it's like he's a happier person. So I think when I ask the question, and again, I admit to not having the answer, is this a fundamental change to the dynamics? And I lean in the direction to some degree it is. It's a fundamental change to the dynamics, and that is going to mean as the leases slowly start to mature, as the mortgage loans start to mature, as all these different things continuing to layer, that we are looking at what are we going to do? What are we going to do with all the empty office space? And it's not just the empty office space. It's like the commuter rail lines, where people aren't taking the train into New York anymore. It's all the retail space. Everybody that dropped off their dry cleaning on the way to work and then picking it up, they're not doing that anymore. All the restaurants, all of that stuff is going to change. And so far, we've seen some of it. We've seen a little bit here and there. I don't think we've seen that big boom. And I think and that's why I push on the notion of let's get ahead of this. Let's start asking the questions. Let's start looking at the portfolios. Let's start finding out what's in there. And if you're looking at a life company, a good place to start is LR004. Get that and start going over that data and seeing, well, okay, tell me, you got this thing that's got, on a rolling 3-year basis, has debt service coverage of, 1.01, and that's on an interest-only loan. What happens to that when that matures next year? I think this is where we need to start asking a lot of questions and getting ahead of it and knowing, what we're going to have to deal with if, in fact, it doesn't suddenly, we're all happy, we're all back, it's fine and dandy.
Yeah, I don't think it's gonna go back.
All right, you heard it from Mustafa. Mustafa says it's not going back.
Based on talking to companies,
Yeah.
they are not.
Yeah,
really,
yeah,
Max is gonna be 2-3 days.
yeah,
If that.
yeah. So,
So far, we don't
yeah,
know what's
well,
gonna
we don't know. We don't know. We also don't know if the Chiefs are going to win the Super Bowl again. All right, Bruce just pointed at his watch. So I'm here if you want to talk. I'm going to go grab lunch. But this was great. Thank you for coming.